Good morning from Tokyo. This is TOITOI Japan Market Radio for Wednesday, February 11, 2026. I'm your host, bringing you the essential briefing for global investors tracking Japanese equities, the yen, and rates. Today's session was unusual, so let's get straight into what you need to know.
Thanks for having me. Before we dive into the broader market themes, I should flag that Japanese markets were actually closed today for a national holiday. So there was no trading in Nikkei 225, TOPIX, or JGBs domestically. That said, there's still plenty happening in offshore markets and policy developments that matter significantly for Japan positioning.
Exactly, and even with Tokyo closed, we saw some important headlines that could shape sentiment when markets reopen tomorrow. Let's start with what caught my attention overnight. Bloomberg is reporting that former President Trump is privately weighing a potential withdrawal from the USMCA trade pact, the very agreement he negotiated during his first term. This is significant beyond North America.
It absolutely is. On the surface, USMCA is a trilateral agreement covering the United States, Mexico, and Canada, so you might think it doesn't directly touch Japan. But the underlying signal here is what matters for Japanese investors. If Trump is genuinely considering walking away from a trade deal he himself championed, it tells us that unilateral trade policy and protectionism could be back on the table in a more aggressive way. That has direct implications for Japan's export-heavy economy.
Walk us through the channels. How does a potential USMCA withdrawal translate into risk for Japanese equities and the yen?
Sure. First, on equities, Japan's major exporters in autos, electronics, and semiconductors are deeply integrated into North American supply chains. If the U.S. starts dismantling existing trade frameworks, it raises the probability of broader tariff actions or renegotiations of agreements like the U.S.-Japan trade deal. Sectors like autos and industrial machinery would face headwinds, which would weigh on Nikkei and TOPIX, especially the export-sensitive components. Second, this kind of trade uncertainty typically triggers risk-off sentiment globally. In that environment, the yen often strengthens as a safe haven currency, which ironically hurts the same exporters by reducing their repatriated earnings.
So we're looking at a double-edged sword for Japanese equities. What about Japanese government bonds?
JGB yields would likely drift lower if risk-off sentiment dominates and global investors rotate into safe assets. We've seen this pattern before where trade tensions push capital into Japanese government bonds, compressing yields even as the yen strengthens. The key watch here is whether we get any formal announcements on tariffs or a specific timeline for USMCA withdrawal. Until then, this is a sentiment risk rather than an immediate repricing event.
Staying with the equity theme, we also saw a notable headline about the Nikkei 225 from the previous session before the holiday. The index surged 2.28%, with SoftBank Group leading the charge with a gain of 10.68%. That's a remarkable single-day move for such a large cap stock.
It really is, and the mechanics here are important for global investors to understand. SoftBank carries a weighting of more than 7.5% in the Nikkei 225 index, which is price-weighted rather than market cap-weighted. So when SoftBank jumps 10.68% in a single session, it can account for a substantial portion of the index's overall gain. In this case, a significant chunk of that 2.28% Nikkei rally was driven by SoftBank alone.
Do we have clarity on what drove SoftBank's outperformance? Was this a company-specific catalyst or broader market momentum?
That's the key question. Without detailed intraday commentary, it's hard to pinpoint a single catalyst, but there are a few possibilities. It could be related to vision fund performance, rumors of asset monetization, or simply renewed investor appetite for high beta growth names in a risk-on environment. What we do know is that this kind of move typically correlates with yen weakness and broader risk appetite. If investors are rotating into Japanese equities, especially heavyweight growth stocks, it suggests confidence in the global growth outlook and tolerance for carry trades.
And that would have implications for dollar-yen, correct?
Exactly. In a risk-on environment, the yen tends to weaken as investors move capital into higher-yielding or growth-oriented assets. We would expect USD, JPY to move higher on that kind of sentiment. The challenge for tomorrow's session will be whether that momentum can sustain, especially given the trade policy uncertainty we just discussed. If Trump headlines intensify, we could see a reversal where the yen strengthens despite equity optimism.
Meanwhile, there's another global fixed income story that has indirect but meaningful implications for Japan. Bloomberg reported that China has continued its multi-year retreat from U.S. Treasuries, and the article flags bigger systemic risks in that trend. Why should Japan investors care about China's Treasury holdings?
This is a really important structural shift that doesn't get enough attention in day-to-day market commentary. China has been steadily reducing its U.S. Treasury holdings for several years now, and that reflects a combination of factors, including concerns about U.S. fiscal sustainability, currency diversification, and capital allocation priorities. Japan is typically the second largest foreign holder of U.S. Treasuries after China, so we face similar macro pressures. If China's divestment continues, it could push U.S. Treasury yields higher, which has cascading effects for Japan.
Walk us through those effects. How does rising U.S. yield pressure translate into Japanese market moves?
Let's break it down by asset class. For Japanese equities, rising U.S. yields are a mixed signal. On one hand, higher yields can pressure equity valuations globally, especially for growth stocks. On the other hand, if U.S. yields rise relative to Japanese yields, that typically widens the USD, JPY carry, which weakens the yen and benefits Japanese exporters. So you get conflicting forces. Autos and tech could rally on yen weakness, but overall market multiples might compress.
And for the yen itself?
If U.S. yields rise because of China's Treasury sales, that would ordinarily put upward pressure on USD, JPY, meaning a weaker yen. However, if the Treasury sell-off sparks broader risk-off sentiment or concerns about U.S. fiscal stability, the yen could actually strengthen as a safe haven. So the directionality depends on whether this is perceived as a technical supply issue or a macro regime shift. Right now, I'd lean toward modest yen weakness if yields rise in an orderly fashion.
What about Japanese government bonds? Does this put upward pressure on JGB yields as well?
Potentially, yes. If global yield expectations shift higher, Japanese institutional investors might rotate out of JGBs and into higher-yielding US or European bonds. That would add modest upward pressure to JGB yields. However, the Bank of Japan's policy stance remains the dominant factor here. As long as the BOJ maintains its accommodative posture and yield curve control framework, any JGB yield moves are likely to be contained. But this is something to monitor closely, especially if we see coordinated moves by other Asian central banks.
So the key distinction is whether China's Treasury retreat is a tactical repositioning or a structural regime change.
Exactly. If this is a long-term shift in how major reserve holders allocate capital, it has profound implications for global bond markets and currency dynamics. For Japan, it could mean higher funding costs, wider spreads, and more volatility in the yen. But if it's just periodic portfolio rebalancing, the impact will be much more muted. The Bloomberg report suggests the former, which is why this deserves attention from global investors.
Let's bring this back together for our audience. We've covered trade policy uncertainty with the USMCA story, equity momentum driven by SoftBank, and structural shifts in global bond markets with China's Treasury holdings. What are the key themes investors should be watching when Tokyo markets reopen tomorrow?
I'd say there are three main themes. First, watch how Japanese equities react to the trade policy headlines. If Trump's protectionist signals intensify, we could see pressure on export-heavy sectors, particularly autos and industrials. Second, monitor USD, JPY closely. We have conflicting forces right now: risk on sentiment from the previous session's equity rally versus potential safe haven demand if trade uncertainty escalates. Third, keep an eye on JGB yields and any commentary from the Bank of Japan. If global yields continue to drift higher, that could put pressure on the BOJ to adjust its policy stance sooner than markets expect.
And from a positioning standpoint, what should global investors focused on Japan be thinking about?
I think the key is to separate short-term volatility from longer-term structural trends. The SoftBank-driven rally was impressive, but one session doesn't make a trend, especially with a holiday disrupting momentum. On trade policy, we've been here before with Trump, so experienced Japan investors should have playbooks for managing tariff risk and yen volatility. The China Treasury story is the one that could have the most lasting impact, because it touches on global capital flows and the sustainability of the post-crisis monetary regime. That's a multi-quarter theme, not a multi-day trade.